Hey guys, hope you are all having a fantastic Monday. There was a series of developments that happened and we need to talk about it. There was a surge of protests breaking out across all of China over the weekend. This is reportedly happening as a result of the restrictive policies being enacted by the government to control the spread of the virus. The unrest came as infections seem to be surging again, which is prompting more COVID controls. After nearly 3 years, the Chinese economy has continued to be deeply affected. Youth unemployment has neared 20%. What is happening is no small thing, and you will not see many other YouTubers talking about it because this platform has already begun censoring any videos on this matter for some reason, which is also why I cannot show you guys footage of what is going on, but let me tell you, it's not looking good out there. Now, this will have serious ramifications for stocks all over the world, something the media has been trying to downplay in attempts to not cause a massive drop in this market rally we have been enjoying these past few weeks. One of the biggest losers is Apple, who is reported to lose about 6 million iPhone Pros from the tumult taking place in the Chinese plant. Much of what will happen depends on how quickly Foxconn Tech can get people back to the assembly lines after the protests began to turn violent. If China ramps up lockdowns as they appear to want, productions are going to be set further back and we will see the stock market drop, perhaps even breaking to a new low for the year. For those that don't know, Foxconn facility produces the vast majority of iPhone Pro devices, which just happen to be Apple's most in-demand handsets this year. Apple has already lowered its overall production target to about 87 million units from the earlier projection of 90 million units. This situation is developing as I am writing this, so depending on how long the protests last and how the Chinese government reacts will determine a new outlook for the global economy. However, if you think China is the only country we should be worrying over, think again. It's been a while since we talked about Canada, and upon looking at some of the new sets of economic data that has recently come out, Canada is without a doubt bordering on an imploding economy. As of right now, Canada has a private debt to GDP ratio of 230%. For comparison, before our American financial system crashed down in 2008, the United States had a private debt to GDP ratio of 170%. Canada's financial system is more vulnerable than ever before. As explained by Jordan Bauer, when a country's housing market goes up for 30 years straight, people go crazy, and this is exactly what happened in Canada. There are towns full of empty vacation homes, with mom and pop real estate investors and parents co-signing on mortgages their kids can't afford. Now that the pains of this 30-year run is coming to a halt and pain is starting to spread across not only housing investors and owners, but across the entire global economy. Soaring rates have squelched demand and sent home prices down. These next couple of months will be holding clues as to how many people are going to be left homeless. By March, it will be a year since the Bank of Canada began raising interest rates. This means that a significant amount of people who took out short-term or even floating-rate mortgages at historically low rates will find themselves fully exposed to the roughly fourfold jump in borrowing costs. The fate of Canada's housing market will depend on whether or not these people can continue to make payments. If they begin defaulting, the housing market will come to a crash, which will in turn spread to other sectors of their entire economy and therefore the rest of the world. As the leader in the years-long global real estate frenzy, they are now the one that the rest of the world is looking at to see if things are set to decouple and crash or if things just continue to hold at current levels. Let's bring back the topic of discussion back to the US. American consumer confidence fell in November to a 4-month low amid the double blow of persistent inflation and rising interest rates. The Conference Board's index decreased in today's data. The measure of expectations fell to 75.4. The combination of inflation and interest rate hikes will continue to pose challenges to confidence and economic growth into early 2023, according to Senior Director of Economic Indicators at the Conference Board. What was even more shocking was that the global bonds joined US peers in signaling a recession, with a gauge measuring the worldwide yield curve investing for the first time in at least 2 decades. The average yield on sovereign debt maturing in 10 years or more. That has never happened before based on data going back to the beginning of the millennium. The inventions, according to Bloomberg, is typically seen to herald a recession, as investors switch money to longer-term bonds due to pessimism over the economic outlook. Those fears are growing as policymakers around the world pledge further monetary tightening to tame rising consumer prices. On top of this, European Central Bank President Christine Lagarde signaled more rate hikes are likely, saying she would be surprised if Eurozone inflation has peaked. Then comments by 4 Federal Reserve officials yesterday flagged the probability that rates need to go higher. Remember when I told you this would happen? I warned you all to get ready for higher rates when the market began to rally with optimism that the Fed would pivot. Once again, we were ahead of everyone and called it right. As I have said, Europe is already in a recession, with Germany being deep in it. The United States is also in one, though it is not admitting to it. Based on my own prognosis of things to come, I think that sometime around summer next year, the United States will enter an economic state where it is no longer feasible to deny that we are not in one, and once the government officially declares the recession, that's when I think markets are going to really drill and we could begin to see a full-on market crash unfold before our eyes. This market rally we have been experiencing might be the biggest fake out in history. The global yield curve invasion comes as bonds enjoy a rebound really on prospects that a slowing economy will spur policymakers to slow or even halt rate hikes. U.S. long-dated Treasury yields on Tuesday remained near lows struck in early October, with the yield curve near its most inverted levels in decades. Now, if you remember a couple months ago, we talked about how the Fed would handle higher inflation or persistent inflation. We said rate hikes might not be in 25-point increments anymore, but a more subtle and small increase in order to try to not cause further market panic. It appears to me that this assumption is looking more and more likelier based on the comments of one key official at the Fed. New York Fed President John Williams said strong demand for labor, stronger demand in the economy than he previously thought. As such, he said he believes interest rates are headed somewhat higher than he had forecast just a couple of months ago. At a separate event, St. Louis Fed President James Bullard, who is of the central bank's most hawkish officials, said he thinks markets are underpricing a little bit the risk that the FOMC will have to be more aggressive rather than less aggressive in order to contain the very substantial inflation that we have in the US. This is not to say that anything is set on stone, but it gives you a clear idea that if inflation is persistent or begins to inch up, the Fed will not even hesitate to hike up rates in an instant. The recovery of this economy is not going to be quick at all. It will be a long drawn-out process that will be full of pains and stumbles, which is why watching the market rally the way it has for the past weeks has been so dissonant, not only with me, but with the Fed, who, as I said, also needs stocks to not make big rallies, as that will only make inflation worse. Fed officials might have signaled their plan to raise their benchmark rate by 50 basis points at their final meeting this year after 4 consecutive 75 basis point hikes. The main rate is currently in a target range of 3.75% to 4%. Investors are in general agreement that they see it peaking around 5% next year, according to the pricing in futures contracts. Federal Open Market Committee Vice Chair Williams said he does see a point, probably in 2024, that they will start bringing down nominal interest rates because inflation is coming down and they would want to have real interest rates appropriately positioned. Cleveland Fed President Loretta Mester said in an interview published on Monday that the central bank wasn't yet near a pause in its rate hike campaign. Williams said his baseline view is that we are going to need to raise rates further from where we are today and that we are going to need to stop restrictive policy in place for some time, at least through 2023. Bullard, my favorite Fed president since he seems to have the same perception I do, also had an interview where he reiterated his view that the Fed needs to at least reach the bottom of the 5 to 7% range to meet policy markets' goal of being restrictive enough to stamp out inflation near a 4-decade high. In order to simplify this, let's talk in common sense. Guys, inflation is high and it is persistent. Clearly the Fed's rate hikes have done well to stop its growth but have not had much success in reeling it back. All indicators are pointing to a recession sometime in 2023, and most investors believe it to be as well, which is even more impactful as trading and price action will be determined by investors. With these things in mind, the Fed needs to accept things for what they are and just go all out with rate hikes to quell inflation. Not doing so or being too careful and soft is going to have a compounding negative effect in our ability to recover. This isn't a deal about avoiding a market crash or recession, that already seems to be set in stone. What we are now deciding is how long will it take us to recover from the fall, and the Fed will do great to stop caring about what the market wishes or the pipe dreams of the current presidential administration and instead focus on what's ahead. This recession is all because of their doing with unlimited and irresponsible money printing, which mostly went to the banks and Wall Street. Now, it is kinda jarring to see some officials voice concerns about the pains these corporations might face. Hey, they did not look to be in pain when they took all those taxpayer-funded loans and still fired their employees, breaching the contracts they signed. Instead, they pocketed all that money and bought back stocks to pump them up to the moon, sending the stock market in a historical rally like it has never been before. Now they are worried about some long-term pains and are voicing the Fed to be gentle. Clearly appealing to their short-term needs is not going to yield the results we want, so I honestly applaud Jerome Powell on his determination to remain hawkish so far and wish for him to continue being hawkish and raise those rates up next year even further. The economic recession is pretty much 99% unavoidable at this point. The government would have to pull out miracle after miracle to avoid it, and I am sorry, but I am not feeling particularly confident with the White House, Congress, or the Fed. As such, focus should remain on battling inflation until it's beaten down to below 3%. After that, then I think we can begin to have discussions about being more dovish. All in all, we were right about the Fed and what they would be doing in previous videos. I saw a lot of people on social media celebrating a dovish Fed, but we remain skeptical, and it seems that once again, we hit the nail in the center with it. The Fed is insecure. Economic data suggests recession, with more evidence mounting up every day that dates it sometime around summer next year. Canada is an atrocious mess with a housing market that seems to be on the edge of doom, and China's new riots are going to cause American corporations billions if not trillions of dollars if it is not quickly fixed. Furthermore, the pains of a long-lasting pandemic are true, and the restrictions imposed by China could further harden our own ability to continue climbing up. There is not a single piece of evidence outside of that last CPI report that suggests we are making any progress, and as a result of that, based on the evidence I see before me, not even acknowledging cryptocurrency, which to say is a mess would be the world's greatest understatements, I continue to remain bearish on the market long term. I acknowledge the market's lack of sense in these small-term bull runs, but I am a bear so long as evidence suggests so. Thank you all for watching this little video. I shall see you soon for another one. Come join my Discord and follow me on Twitter, and hope to see you on the next one. To the moon.